Welcome to the Explainer from Wall Street Insights. Today, we're cracking open a document every finance pro knows inside and out, the 10Q. We're going to use it to look past the headline numbers and see what's really going on with a company's strategy and its health. And our case study today is the New York Times' really impressive Q2 2025 earnings report. So we'll quickly touch on the 10Q itself, then jump right into the Times' performance, their digital engine, how they're handling risks, and finally ask if their playbook is something others can copy. All right, let's set the stage. You know, the story of any public company is really told through its filings. And for us today, the key document is the Form 10Q. Now, as you all know, the 10Q is that mandatory quarterly report card from the SEC. It's the most timely, official snapshot we get into a company's operations, which makes it absolutely essential for tracking what's happening between those big annual reports. And the key difference here for what we're doing today is that immediacy. You know, the 10K is that massive, audited deep dive at the end of the year. But the 10Q, even though it's unaudited, gives us that fresh, tactical data we need to spot trends and strategic shifts as they're happening. And that's exactly what we're looking for with the New York Times. Okay, before we dive into the numbers, just the standard disclaimer. This is all for informational purposes. It is not investment advice. Everything we're talking about is pulled directly from public documents. With that out of the way, let's put this into practice. We're looking at the New York Times second quarter of 2025. And honestly, it was a huge success by just about any metric. So, the first big number that jumps out from the 10Q is total revenue, coming in at almost $686 million. That's a 9.7% jump year over year, which is a really strong growth number, especially when you consider how soft the broader ad market has been. But revenue is only part of it. For me, this is where the real story is, on the margin. Adjusted operating profit just surged by nearly 28%. That screams operating leverage. It means they're scaling their revenue way faster than their costs, which leads to some seriously healthy profitability. And all that profit, well, it flowed right down to the bottom line. Adjusted diluted EPS hit 58 cents. That's a jump of almost 29% from last year. This is exactly the kind of bottom line growth that gets investors to sit up and pay attention. Now, what puts these great numbers into perspective is how they stacked up against expectations. I mean, look at this table. The Times delivered a pretty significant beat on both revenue and earnings. They blew past what the analysts on the Street were predicting, and that's a huge signal to the market that their strategy is working even better than expected. So the obvious question is, right, how did they do it? Well, the 10Q lets us peel back the onion, and what we find is this incredibly powerful story about their digital strategy. It's just firing on all cylinders. Just a quick look at the revenue mix, and it confirms everything. Subscriptions are the heart of the business now, bringing in over $481 million. You know, this pivot to a reader-first revenue model, it's the holy grail for media companies. It gives them a predictable, recurring revenue stream that insulates them from the wild swings of the advertising market. And this chart, wow, this is the entire transformation story in one picture. Just look at that staggering 15.1% growth in digital-only subscription revenue. It is absolutely dwarfing the slow, managed decline of the print business. This is the pivot, live and in action, going from a legacy company to a digital-first powerhouse. And the CEO, Meredith Kopit-Levien, points out a huge milestone in the report. Over half their subscribers are now on the bundle. This is a total game changer. It drives up average revenue per user, or ARPU, but maybe more importantly, it makes those users stickier. That means less churn and a much higher lifetime value for each customer. But you know, a 10Q isn't just a victory lap. It's also a brutally honest look at the challenges coming down the pike. So let's look at the risks the Times is facing and the smart pivots they're making to handle these industry headwinds. The report calls out a few big ones. You've got the ongoing cost from the big lawsuit against OpenAI and Microsoft. There's general economic uncertainty, which can always hit ad budgets. And then there's this huge one for all publishers, getting less and less referral traffic from Google and social media. And they put a hard number on that AI fight. The company booked $3.5 million in pre-tax litigation costs just this quarter. Now, that's not a huge number for a company this size, but it's a signal, right? It tells you this is going to be a long, costly fight over their intellectual property. But here's the smart move. They're not just suing people. They're also making deals. The CEO points out they just signed their first major licensing agreement around generative AI, and it's with Amazon. This shows a really savvy two-pronged approach. You sue to protect your IP, but you also cut commercial deals to get paid fair value for it. Okay, so let's boil all this down. If you distill this whole 10Q down to its essence, what are the key strategic lessons we can take away from this amazing quarter from the New York Times? Well, first, it's clear their digital transformation is paying off with serious operating leverage. Second, that bundle strategy is just a masterclass in boosting ARPU and customer LTV. Third, they are living proof that a legacy brand can absolutely pivot and dominate in a digital-first world. And finally, that two-pronged AI strategy, it's a very sophisticated way to manage a huge existential risk. And that really brings us to the big final question, doesn't it? Is what the Times has pulled off a replicable blueprint that other media companies can actually follow? Or is their brand, their scale, and the head start they got just so unique that it simply can't be copied? That is probably one of the biggest debates in the entire industry right now. And that's our explainer. For more deep dives like this, digging into the stories behind the numbers, make sure you follow our public account, Wall Street Insights. And hey, if you found this valuable, we'd appreciate it if you'd like and share. Thanks for joining us.